Hello and welcome everyone, and welcome Jeremy Sagi. Jeremy, you are one of the founding partners and Chief Investment Officer of Arena Capital Advisor. For starters, can you please explain to us what Arena Capital is all about?
Sure. Arena Capital is really about short duration high yield. Whether it is within high yield or levered loans or busted convertible bonds, we really focus on the short duration corporate public debt markets. And currently we've been in business for over 10 years. And we have about $5.5 billion under management right now, and are very excited about our future growth.
So Jeremy, perhaps you could briefly explain to us and our investors what is so special about this asset class, and when you compare it to other asset classes like US investment grade or equities or emerging market debt.
So short duration high yield is basically, in our opinion, the best risk reward within the public corporate debt market. You can look at investment grade, you can look at high yield, and one thing that in particular is very different within the high yield market as a whole, and in particular within the short duration high yield market, is the fact that you get more return for less duration. So for the high yield market, and in particular the short duration market, a 1-year bond on average actually yields more than something that is a 10-year bond, which doesn't make any sense. If you look at the investment grade market, yes, it basically, if you go out wider, then the spreads go up higher. And for high yield, for some reason, that is not the case on an average basis. Of course, if you look at any particular thing, there's different things. But if you look at the asset class as a whole, it consistently, over 90% of the time, has an inverted yield curve, which gives you more value for being shorter, which actually shorter is easier to determine whether it's a big risk or a small risk. So we like to take advantage of that. In addition, there's not a lot of competitors within the short duration high yield space. If you look across the high yield spectrum, there might be, 200, 300, 400 different funds out there. Within the short duration segment, there might be 40 to 50 funds. Yeah. And of those 40 to 50 funds, they probably have traditional mandates that actually just, passively invest in short duration. If they're okay with the long duration bonds, they'll buy the short duration bonds. And we have a dedicated team versus others don't. And these are a little bit probably going on to why Arena is good. But in general, short duration with a focus on short duration and being able to take advantage of that yield curve is very, very strong risk reward proposition for all investors.
Interesting. And you were already getting into that, but when you compare your investment approach with those of other asset managers, what makes your approach special?
So number one is the dedicated team. Having that team, and most of that team has been in place now since the inception of Arena. And we're really proud of the returns we've been able to provide for our investors, both on an absolute and on a risk-adjusted basis. So I'll say team number one. Number two, I feel that our capability to focus on structural aspects of a high yield bond. Mm-hmm. Most people will look at optionality within a high yield bond as being a negative. Mm-hmm. They have a term called negative convexity, where you really can't make money, but you can only lose money, is what most managers will say. Well, we will say, based off of how we focus on that structural analysis, is you can take advantage of it if you can determine when a company will not refinance a bond, when economically it makes sense for them to do so. So that structural focus, which we can get into later if you want, or if we have a meeting later on with other investors, can really be powerful in having our team and Arena as a whole focus on income returns rather than focusing on total return, which is what most people in the high yield market do. I think another aspect of what we do really well is we don't just touch high yield bonds for most of our investments. We also have busted convertible bonds in the product that we do with you. In other products, we also have levered loans that we like to layer in. And the relative value and the relative attractiveness of all these different asset classes change at all times. And we are very good at being able to identify value and protecting risk. And I would say number one is we are downside protection focused. And we really focus on protecting your capital and making income on the capital that you give us.
Thank you. And if we take a look further, like what is your outlook on the US high yield market and how do you assess interest rates in the US for the future?
So that is a very interesting question. When it comes to the overall high yield market, spreads are historically at the lower end right now. So that makes people hesitate to actually invest. However, if you look and you see the average quality of high yield the last time that spreads were close to this area, the triple C bucket was much greater. So that's the first point that is very important to know, that we can actually get to lower spreads and do so because the quality of the high yield market has improved dramatically as a lot of the undesirable or the less quality names have moved into the private credit world. So we do view that as a potential opportunity. Of course, we would all like spreads to be wider. We always do. Yes. But in terms of being able to find value, we are still identifying value. And then on top of that, it's a very bifurcated market right now. So even though spreads look tight, if you have a good manager that's able to, pick up every stone and focus on trying to get that income type of return, we of course find value in this market right now. And we are playing safe. We're being a little bit more conservative because of where spreads are, but we're still able to take advantage of the structural aspects of high yield and provide that for our investors and give them hope of a much better return than what it looks like the stated return is. And even now, our yields in the portfolio are around 7% versus the market being at around 6% for the double BB spectrum, which is what we really focus on for your clientele. So going a little bit in Arena, a little bit on outlook, and then finally on interest rates, we believe that short-term rates will probably go down. It really feels like the American president is able to get his agenda done. That is not necessarily, I'm not trying to be political here, but he is able to put the pieces in place, it feels like. And whether what he's doing is good or wrong, that's not what I'm here to say. But I will say there's a very high likelihood that the new Fed chair next year will most likely be not elected, but be chosen by President Trump to lower interest rates. And therefore, you have to protect that. So what are we doing in the portfolios for that? We're reducing the floating rate exposure. We're increasing the fixed income exposure. And look, I mean, there's a saying, don't fight the Fed. So even though we are very conservatively positioned, we are sporadically choosing some names that might have very good downside protection, but have really good upside protection if all of a sudden equities rally, even though we believe on a whole they're overvalued. At the end of the day, things can always get more overvalued. So we're putting that in place in all of our portfolios and feel that rates will be lower on the short end. Can't tell you about the long end. If I was, you'd be not sitting here. I don't know. I think we used to do this thing, probably every single year at my old shop, where we would try to guess where the 10-year would be. No one was ever right. No one was ever right twice. You can always get right once because of luck, but no one was ever right. And almost every time we were off by more than 100 basis points. If you take the average of all of the guesses, because that really is what it is. So I can't really guess that, but for the first time in my career, I feel very, very strongly that short-term rates will be lower, which in a short duration portfolio will be very conducive to good returns.
Jeremy, thank you very much for your very interesting explanations, and we're very much looking forward to going on the path with you.
Thank you very much. I enjoy it, and even our path has been now over 10 years. So
definitely,
looking forward to the next 10 years.
Same here. Thank you very much.
Thank you. Take care.